Can I actually retire early before age 60 with structure, clarity, and peace of mind? Today, we're going to walk through 5 income and tax layers that most people either misunderstand, underutilize, or build in a way that quietly works against them over time. We will go deep into each one, the pros, the cons, the cautions, the real planning insights, because surface level awareness is not enough when it comes to retiring before 60. If you have been working hard, earning well, your personal life has evolved, saving consistently, investments are building, and doing everything you were told to do so financially, there is a moment that begins to surface quietly and only gets louder. Not someday, not eventually, but sooner. Because for many people, the numbers may look strong on paper and screen, but internally, something feels uncertain. And for many people, that uncertainty quietly turns into one question. Am I actually building this the right way for my own wealth and life alignment? That uncertainty does not come from a lack of effort. It comes from not fully seeing how everything is connected.
With over 10 years of guiding people to retire earlier, wealthier, or happier when possible, all too often financial planning is often presented as numbers problem only. But in reality, it is also a structure problem and a clarity problem. When the structure is unclear, the mind keeps analyzing and overthinking. The nervous system stays unsettled, and decisions that should feel grounded feel heavy instead. Most people were taught to accumulate, save more, invest more, and max out certain account types. And while that builds wealth, it does not automatically create flexibility, access, or true alignment for your own life goals, needs, and your own retirement dreams.
So we'll also go deeper into healthcare before age 65 and what happens to your account types from a tax perspective when they're passed to your estate inheritance plans. Because those two areas alone are most always underplanned until it's too late to do anything about them.
Now, my name is David Lumberg. I am the co-founder of Awaken Financial Designs. We are a fiduciary RIA headquartered here in North Carolina and in Arizona, and we help people retire earlier, wealthier, and happier. Since 2015, we've been guiding individuals. I do have a double master's, a certificate in financial planning, and I also am a Marine veteran.
Yes, and I'm Ashley. I'm co-founder of Awaken Financial Designs. I am a wellness coach and financial educator. I have my master's degree in business leadership, and I too help people retire earlier, wealthier, and happier.
Now, this is all educational only, not financial, tax, or legal advice. These are only examples here as well. Always consult a qualified professional about your own situation, your own goals and needs.
So David, before we get into the 5 layers, I want to start with something real. Why do so many people who may have 500,000 or even people that we know that have 8 million who are generally doing everything right still feel that uncertainty or even anxious about whether early retirement is actually possible for them?
Yeah, no, I mean, it's a great question on here as you brought up on there. And we've had people that have $500,000, people have 2 million, and there are some that have $8 million on it, and they still have that uncertainty there as well. And it's because that uncertainty, it's rarely about just the numbers alone. It's also not being able to see visually how those pieces actually connect in your own life, in your present, in your future as there as well, into giving you the guidance and clarity. Because people have that anxiety. They feel uncertain because they may have multiple account types in multiple places. Maybe it's a 401k or a TSP. Maybe it's that brokerage account. Maybe they have RSUs or NSOs. Maybe they have a Roth IRA or an IRA. Maybe they get paid bonuses and salaries. There's a huge connection out there. But usually nobody has ever sat down with most people and shown them how all of it works together, how towards a single outcome that they're in for, or ways they can optimize it by making more efficient maneuvers that we're going to go over here today in this video with these 5 layers to make these changes.
And so beyond the financial piece, there's something much deeper happening. When people think about retiring early, there are real questions underneath, the money questions. What does my life look like without a career defining it? What's my purpose? What happens to my identity? What happens to my relationship with my spouse or partner? Those questions are extremely valid, and they are connected to the financial ones in ways most planning conversations never acknowledge.
Yeah, and that's why we personally here believe that planning should go far beyond numbers alone.
Absolutely.
I mean, math and data absolutely matter. Numbers do matter, but we use advanced planning software, like many planners out there do, to model these outcomes, right? With the math, with the data, with the numbers, and with the science on there, so you can visually see that, but that's only one true part of the overall equation to us. The other part is how those numbers integrate with your own life, your decisions, and your sense of clarity with what true awareness is for yourself. You know, what we often see consistently with families and individuals, whether it's here in North Carolina or in Arizona or virtually elsewhere, is that when people finally see how their different account types, their incomes, their taxes, the different layers that we're talking about today can actually connect and coordinate together, something shifts deep within.
Absolutely.
That anxiety, it starts to lift, not because the numbers suddenly look different, they could be the same, but because the picture becomes clear. That clarity was provided with the visuals and with the understanding, because clarity is not just a financial outcome. It's an emotional one that impacts the nervous system as well in so many ways.
So the shift is from not just saving more and hoping all works to actually understanding the structure of what you've built with the various choices available.
No, I mean, it exactly does exactly. And that's the distribution between the accumulation and the strategic coordination is often the difference retiring earlier at 50, 55, or even 60, or working until age 65. So it's about that accumulation. It builds wealth, but the strategic coordination creates that freedom. And of course, being more proactive, right? If you're in your 40s, you got more time and years in advance, so we can apply these principles today to help you possibly retire earlier. Maybe you're in your 50s already. You could still utilize these tactics. Or if you're someone who's already getting ready to retire in a year or two, this is still valuable information so you can better understand your own account types and to maybe have a greater net income coming to you throughout your retirement too. So really on here, let's walk through the 5 tax and income layers. These layers apply whether you're a couple, a family, or an individual, whether you have kids or don't have kids, whether your income's $150,000 a year, $500,000 a year, or even $2 million a year, right? The variables change, absolutely. The numbers change, absolutely. But the structure and the layers themselves remain consistent, right? The tax code and the rules, they stay consistent as well. So the question is not whether you have these layers. Most people do in some form or another. The question is whether they are working together intentionally or simply existing separately without a strategic coordination. Now, of course, the more proactive you are, as we said earlier, the greater the results can typically be as well.
So as you can see on the screen, these are the 5 layers that we'll walk through. And after the 5 layers, we will cover healthcare and legacy tax planning as well, because those 2 areas, as mentioned, are important too. Layer 1 is taxable brokerage layer. Layer 2 is tax-deferred accounts. Layer 3 is Roth and tax-free assets. Layer 4 is variable and complex income. And layer 5 is protection. So layer 1 of 5 is the taxable brokerage account or the non-qualified account type. Most people know that it exists, but very few prioritize it or understand the unique advantages it has, especially for early retirement. Why is this consistently the most overlooked layer?
No, it's a great question on here. This is one of my favorite account types out there. It's not talked about a whole lot, but a lot of early retirement planners who specialize in this talk about this account type here as well. And without going into too many deep reasons as to why this is, it's because everything in the American financial culture and in the workplace, it points towards tax advantage retirement accounts, especially that 401k or a TSP or a similar employer retirement plan. Then people are told to contribute maybe to the IRA or the Roth IRA without a whole lot of guidance or clarity on the coordination on there. And those are not bad instructions or tactics, but they are incomplete instructions or an incomplete blueprint that leave out one of the most critical accounts for anyone, especially who wants to retire earlier before age 60. So, I mean, here's the fundamental problem, right? Your 401k, as example, or your traditional IRA, or even that Roth IRA, they all have age-based access rules. Now, majority of the time, accessing those accounts before 59 and a half years of age generally means penalties, restrictions, and of course taxes that were not part of the plan,
Right.
which we're going to discuss further. Now, a taxable brokerage account, also called that non-qualified, non-retirement account, it has none of those restrictions. You can access it at 45, 50, or 55. There's no additional penalties or restrictions on that. Now, that makes it what we would call is a bridge account towards the retirement. So you could utilize this until after age 59 and a half, or you could utilize some of those other account types without all those restrictions and fees
Right.
that are in there. Now, they all work together cohesively as well. However, there's also several tax tactics that we'll discuss later. There's about 4 of them that this particular account type has that the other accounts don't. Now, this is where many people unknowingly delay early retirement, not because they lack wealth, but because their wealth is locked up in places they cannot access it without needing it. Because we ourselves have met so many people over the years that might have 80% of more of their money
Yep.
in a 401k or in an IRA type structure,
Right.
which is amazing. They save that money, they
that's
accumulate that
incredible.
money. They might have 800,000, might have $2 million, but it's in that 401k type.
Yeah.
And they're still working, right?
Right.
But they have these different restrictions, they have these penalties,
Yes.
and they have these fees. So could they still retire earlier? They could, but it's going to be more costly as opposed to incorporating some of these strategies today
Right.
that could save them more money and more years of life as well.
Right. So without this layer, an early retiree is essentially waiting for permission to access their own money.
Yeah, essentially, like if you're choosing to put all your money all the time into a 401k or somewhere else, you're kind of signing up your own self unknowingly or knowingly for these restrictions that are
Right.
out there. And in many cases, they're forced into either complex workarounds
gonna say.
or additional cost. So we're going to go over, though, today some of these workarounds that can exist. Now, one potential workaround, it's called a 72T. That's a distribution as a specific IRS provision that can allow penalty-free withdrawals. Remember, you still pay taxes,
Yeah,
but the penalty-free
gotta pay
withdrawals from the IRA retirement accounts before 59 and a half years of age. So if you take substantially equal periodic payments over a set schedule, it is a valid strategy in some situations, but it is highly restrictive. There's many rules and criteria to a 72T. And once you begin it, you're generally locked in for at least 5 years or until past age 59 and a half. Now, again, lots of rules to this,
Right.
but something to be aware of. Another option is the rule of 55. Now, the rule of 55, it can also allow penalty-free access to that 401k or IRA account. Again, you still pay taxes.
Yeah.
Now, however, that is up to your own employer that might be out there, though.
Oh,
So
okay.
people say the rule 55 for everyone, but it's your own 401k and your own company's plan if they have that rule of 55 provision in there. So you have to ask your own HR
I was gonna
and you
say
have to
HR.
ask your own employer plan, hey, do we allow the rule of 55? And you want to find out, but if they do allow the rule of 55, then you could take out those funds after age 55 without the penalty. But again, taxes still do apply. And so you guys know that penalty we're referring to, there's a 10% early withdrawal penalty. So you would pay a 10% early withdrawal penalty plus any taxes that would apply as well.
Yeah, and there are several unique tax dimensions to this taxable brokerage account that does not exist in others.
Yeah, and this is where the real planning opportunity lives that most people miss, right? That taxable brokerage account has 4 different tax treatments depending on how long you've held it and what it might be in. Now, we're going to go over the 3 most common ones here, and the 4th one's not so common. We have short-term capital gains. You've held that security for less than 12 months. If you sell it and there is a gain, you would be taxed as ordinary income. Then there's the long-term capital gains taxes. You've had that security, that stock or that ETF for more than a year. And if there is a gain and you sell it on the gain, you get the long-term capital gains taxes. Typically, it's more favorable. In 2026, there is 3 brackets, a 0%. Yes, you could get a 0% tax. There's a 15%, and at the highest is a 20%. Now, it's based on if you're single or married at income levels, but you could see the difference between a 0 or 15% bracket compared to ordinary income.
For sure.
Now, there's also your cost basis or the money you put in on there. Now, that cost basis money that was already after tax money. So that's money you can take out and there is no tax on that.
So you mentioned the 4 tax dimensions. So what is the 4th one and what is the caution that people need to hear about this?
Yeah, so the 4th tax one on here on this brokerage taxable account or your non-qualified account type that's so overlooked until it's too late. It's what happens after death. after you die and you pass away on that legacy and inheritance impact. Now we have, towards the end of this video, we go in depth on the taxes and legacies on the different account types on here. But essentially, when you pass away, how you inherit that money for your loved one or your loved one is essential as well. And second, without intentional management, this account can generate unnecessary taxable events, frequent trading, careless dividend reinvestment, or selling the wrong positions at the wrong time. Could have tax drag or erosion. Now, there's also several rewards intentionally if you understand this account type for early retirement. Now, of course, other terms like tax off harvesting, wash sales, a qualified versus non-qualified dividend, and so much more to be aware of, but it's an amazing account type if understood and incorporated correctly.
Wow. So I ask you, are you building flexibility or are you building restrictions for your own self without realizing it?
Yeah, and it's just a great time. You can look at your own current life and write down the different account types you have. Write down the different money you have in there. Write down how much money you put into each one, and then ask yourself why as we continue to go into these advanced layers as well.
Yeah, so layer 2 of 5 is the 401k, traditional IRA, TSP, tax-deferred account types. Now, these are almost everyone knows of accounts. So David, you have said that one of the most common financial mistakes you see is specifically related to these accounts. What is it? Yeah,
regarding the 401ks and similar accounts, the most common issue is blindly over contributing to your employer plan. Very common. And it's one of the most widespread financial behaviors. Now, I've seen this for more than a decade my own self. I've heard it for hundreds of other advisors and books and podcasts and YouTubes. But really, it's because people default to their own employer plan, like a 401k. Because what they were told to do, and it's very easy to do, right? It's super easy. You work somewhere, the 401k is there. You say, take X out of my paycheck. It's all automatic. It all happens easy for you. But easy doesn't mean it's best. Default does not mean it's best on there. And contributing to our 401k, it's not wrong at all. It's a great thing to do, actually, but we need to do it with intention and with strategy and with awareness, because without understanding both the present and the long-term consequences, the picture gets foggy on there. We want to have clarity on there overall to help you retire earlier, possibly. Now, here's what people do not see. When they maximize those tax-deferred accounts, contributions every year for 2 or 3 decades, they're building a very large taxable event in the future. Because at some point in time, that money will be taxed. Now, every single dollar in that account will be taxed as ordinary income when it comes out. There's no capital gains like long-term capital gains rates. At ordinary income rates, and if the balance is large enough, then required minimum distributions, or RMDs, get forced to age 73 even as well. And in some cases, it can even cause what's called your IRMA, a Medicare, to increase. It can even cause your Social Security benefits to have a portion taxable as well if this account type is too much. But again, it's not a bad account type to have. You just have to understand it.
Right. So what should people actually do? Are you saying to stop contributing to these accounts entirely or what?
No, not at all. Not at all. So, I mean, you definitely want to still contribute to these account type if it is available on here. What I'm saying is to understand it strategically on here. So here's step 1. Always capture the full employer match if your employer offers it and understanding it. And if you're not sure, you can log into your 401k portal. It's usually on there. You can ask your own HR or ask your own employer, what is my match and how do I get that match? So for example, if it's a 5% match, then you want to match at least that 5% to get that money on there. Now, step 2 on here is beyond the match. So if it's only 5% and now you're putting in 8, 9, 15%, like so many people blindly do, I would pause and ask yourself, why are you doing that? Evaluate your other account types. Like in layer 1, evaluate that taxable brokerage account. Or evaluate the other layers we're discussing here as well before you just keep putting more and more money in there. Now, for someone in a very high tax bracket, 32% or a 35% bracket, who generally expects to be in a lower bracket in the future, then these tax-deferred contributions and these current deductions that can get now on here could be very beneficial as well, depending. So don't just blindly do it. Pause and ask yourself, what is the match? What am I contributing to? If it's more than match, why am I doing that? And why not put that money into layer 1 or into these other layers we're going to discuss as well?
So really the key is to see that if you have a 401k match, are you contributing to the match? And if more, then asking why. The core insight on layer 2 is this. Tax deferral is a tool. Like all tools, it is valuable in the right application and counterproductive in the wrong one. So the question is not whether to use these accounts. The question is whether you're using them with a full awareness of both of what it says.
Now let's go ahead and go to layer 3 here, Ashley. What's layer 3?
So layer 3 of 5 is Roth IRA accounts. We will say Roth. We'll just say Roth. This is the one that generates the most passionate opinions. Half the financial content, on the internal says Roth everything. The other half says it depends. What is the honest answer?
Now, you're going to hate this answer, but like any true financial planner, it does truly all depend. Now, I'm going to go into specifics and give you examples for things to be aware of on here. And we'll also later on talk about the other popular Roth IRA conversions that everyone talks of that are also misunderstood. So we're going to go into the real facts on here as well to give you this education on these. Now, the confidence people say is do all Roth IRAs. It's always concerning because it reflects a misunderstanding of what a Roth actually does, what it can do, and the impacts, plus both what happens to a Roth when you pass away and you die, which we'll discuss towards the end of this video here as well. Now, this Roth IRA or a Roth 401k, if your employer has it, or even a Roth TSP, if it's offered as well, you want to find out what Roths are available to you on there. And they both have after-tax money they get on there, meaning you've already paid taxes on the money you put in there. That money can grow tax-free. And in the future, if you do qualified withdrawals, the money can be taken out tax-free as well. And we're going to go over those. But as we talked about earlier, that 59.5 rule does apply to Roth IRAs as well, so you want to be careful of that. Now, Roth IRAs do not have required minimum distributions or RMDs like the 401k or the IRA can on there as well. So it's all about combining layer 1, combining layer 2, now combining layer 3 at the Roth on here as well in the right strategic way, but we're going to go more into this.
Yeah, so how does somebody actually know if Roth is right for them or a Roth IRA conversion is appropriate?
No, it's just something we definitely specialize in here ourselves. We have several YouTube videos showing you Roth IRA conversions, break even, data point, everything as well, because we're not about blindly guessing. I mean, this can cost people hundreds of thousands of dollars, whether they're alive or when they passed on as well, which is why we rerun so many real numbers and scenarios from federal taxes to state taxes to city if applicable, to your age, your gender, marriage, and we show you all the projections on here. We show you all the variables that are known on here so you can actually see, is a Roth IRA conversion best for me? What are the break-even points? How much taxes would I have to pay? How does it lower my net income in my retirement on there as well? And also, should I contribute to a Roth IRA if I'm in a current higher tax bracket? And if I can't do that, maybe doing a backdoor Roth IRA. We're going to discuss all this more here as well. But here's kind of a quick example. Maybe you're a dual income family, 30s, you're in your 40s, even in your 50s on there. You have a high income. You might have restricted stock units or RSUs. You might have bonuses as well that put you in that 37% federal bracket, plus your state bracket there as well. That could be expensive in that situation. So maybe instead you do a non-deductible IRA, or maybe you go to layer 1 and put more money in that taxable brokerage account to utilize the future years of the long-term capital gains as well.
So can you explain the Roth IRA conversion strategy more specifically?
Yeah, so the Roth IRA conversion strategy is not contribution. So conversion is not the same as contributions. So with the conversion on there, maybe you have the IRA or you have that 401k and you can convert a certain amount of money. So maybe you have $200,000 in there. You don't have to convert the full $200,000. You can do $100,000. You could do $50,000. You could do $5,000. Whatever number might make sense for you overall, but you want to analyze what are the taxes I'm going to have to pay to do so. What are my ages? What's my status brackets? Why am I doing this? What is the benefit as well? Now, typically, there's a great window for doing Roth IRA conversions, and that is when you choose to stop working. So you and your spouse both stop working. Those are the gap years that we can utilize. You no longer have income coming in. Maybe you're taking money from layer 1 that had a very low tax rate, 0 or 15%. Maybe you have some other money as well, and now we can convert some of that money from an IRA to a Roth IRA, maybe at a 12 or 22% bracket and not a 32 or 37% bracket as well. So that's why it's all about having intention and awareness of this and never guessing.
So what are the rules that people need to understand before touching Roth accounts?
Yeah, so there's two main rules that are misunderstood out there regarding Roth IRAs, especially. Important. Let's go over number 1 here is what's called the 5-year rule on Roth IRAs. This is for the contributions, the qualified withdrawals of earnings are tax and penalty free. only if the account has been open for at least 5 years and you are over age 59 and a half. But here's the part most people miss.
Right.
Most people miss that each Roth conversion you do, did one last year, I did one this year, for example, has its own 5-year clock. So if you do a conversion, and then you try to access the converted principal before the 5 years has passed, and before age 59 and a half, you may owe a penalty on the converted amount. For someone planning early retirement around Roth conversions, understanding this is critical, which is why we like that layer 1 we discussed.
Yes.
The other big rule on here also is what's called the pro rata rule. Now, the pro rata rule refers to the fact of doing these conversions or these back doors on here. And what happens is you have money in the IRA account. Now, you might have deductible money in there, non-deductible money in there. You might even have earnings and growth in the IRA. So it's a mixture. This is where that pro rata comes into play. So doing a conversion to a Roth IRA, a portion of that could be taxable. All of it could be taxable, or maybe none of it is taxable, depending the mix of the IRA account. But be aware of that pro rata rule.
So there is a behavioral dimension here as well. Having access to tax-free income in retirement does create a different relationship with your money. Less concern about pushing into higher tax brackets, more freedom in how you structure withdrawals. When the structure is clear and tax flexibility is built in, decisions become calmer. That's just not a financial benefit. It's a clarity benefit as well. Combining layer 1 and layer 3 correctly could create a 0% taxable situation or less than 10% even.
So now let's go into layer 4 of 5 on here. Actually, what's layer 4?
Yeah, so layer 4 of 5 is one of the most relevant to many of the families that we work with, particularly here in North Carolina and Arizona, where many companies have compensation packages from RSUs, bonuses, deferred compensation, and equity ownerships. So what do people consistently miss?
Yeah, so this is a very complex topic on here. We've helped out many people with these things. We have many articles and videos here we've published here as well regarding this. But RSUs are restricted stock units. Now, they vest on a schedule and are taxed as ordinary income the moment they vest. People confuse this. Once they vest on there, you're taxed. Not when you sell the shares. It's when they vest on there. Not only when you realize the gain the moment they vest, but whatever the share price is on the vesting date, that value is added to your ordinary income. Now, for that current year, now when the RSU vesting lands in the same year as your salary and maybe your bonus, the income can pile up as well. So it's about having awareness and clarity, because if I make $350,000, but I have $60,000 in RSUs coming up in December on there, I have to plan ahead that on my total income for the year is the RSUs plus my salary. So we want awareness of that. That's just one other aspect on here as well on that vesting schedule.
So let's talk about deferred compensation, which we have a prior longer video on specifically because this is the tool some high earners have access to, but generally do not understand.
Yeah, deferred compensation, as Ashley said, we have a prior video that just goes over this as well because it's very complex on there, but it can be a very powerful, misunderstood tool available to certain high income individuals if your company, if your employer allows it, if your HR allows it. Not everyone does, but that non-qualified deferred compensation plan, you want to ask your HR if they do allow it. They'll have a huge PDF book you can get on there to go over the rules and the criteria. But in essence, here's the concept regarding deferred comp. If allowed and if applicable, right? You elect before your compensation is earned to defer a portion of your salary and your bonus into future years as well. You pay no income tax on it now, but you pay tax in the future when you receive it, ideally when your income rate is lower. So for example, right, maybe you're someone to retire at age 55. This creates an opportunity. Maybe I'm making $600,000 right now. And I go, you know what? I want to go ahead and defer 30% of my money. So 30%, 600,000 is $180,000. I defer that out 5 years from now. Well, 5 years from now, if I'm only making $200,000, or maybe I retire, and now I get that $180,000 5 years from now. Instead of me being taxed on $600,000, I'm only taxed on $180,000 in the future years when I'm not working. So the tax is going to be much less as well. So why planning is so important.
Yes, but there are some serious cautions here, rules and criteria, correct?
No, absolutely. Yeah. For deferred compensation or for RSUs even on here as well, you have to be very careful with the rules, with the criteria, with the legalities, with your own company and your own employer and your own HR. That's why it's a key insight out of the 4 of the 5 layers we've been discussing so far But if you do have RSUs, or if you do have deferred compensation, or even equity ownership of a company or your company on there, that's just one of the 4 layers that needs to be understood in a cohesive, comprehensive plan, working together and not separately on there as well.
Yes. And so layer 5 of 5 connects to sequence of return risk and volatility drag, something that we cover in depth in our fixed index annuity video. Why does this layer matter even more for someone retiring early before age 60 specifically?
No, absolutely, because the window is so much longer and there's so many years of exposure and so many years of risk on there that some tactical protections on there are needed. And maybe it is a fixed index annuity, right? Or it's a stock or ETF or a mutual fund or a bond, whatever's out there, right? But a fixed index annuity in the IRA, in that Roth IRA, or in that taxable brokerage account could be a potential benefit on there. But it's about understanding the education and the math and the data. Because when you retire at 55 or at 58, or even later on, you have 30, 40 years, you need to have some protections. You need to have some guarantees on there as well, because the markets will have some kind of downward years. Some kind of crash typically will occur. The markets are not going to go forever. Again, no one knows. It's not a prediction. It's just historically we know the markets at some point in time will go down, which is why we talk about sequence of return risk, why we talk about volatility drag. I mean, Ashley, what are those?
Yeah, so as discussed in prior videos, sequence of return risk is the danger that a significant market decline in the early years of retirement while you're actively taking withdrawals can permanently impair the portfolio in a way that later recoveries cannot fully repair. So as you no longer have income coming in to save and invest, and instead due to no longer working, and now you need to take money out to live. So how does a well-designed plan address this without simply moving everything to conservative investments?
Yeah, it's just about building a structure before it's needed, not being reactive, but being proactive, by having awareness, having clarity. Because again, this is just one of the 5 layers. The 4 prior layers are very important here as well, but it's about approaching a portion of your assets in a stable, accessible form that if a crash happens, if something goes down on there, you know which layer to pull money out of, you know which investments to pull money out of, so that if a crash or something happens with the sequence of return risk or with the volatility drag, you have this particular structure over here that was designed for that. And you have the other layers that were not designed for that. So again, it's one component in an overall plan to help you out with that peace of mind and to complement the portfolio in addition to those stocks, those ETFs, those mutual funds. And for people that want to learn more, we do have almost a half an hour unbiased educational video just on this topic with math, data, and charts, just to give you the education and clarity on that.
So let's talk about a big concern in early retirement. Healthcare before 65 is the area that I think surprises early retirees more than anything else. What do people generally not see coming with this?
Yeah, the number one answer we get from teaching, almost well over 100 classes all these years and talking to thousands of people in person ourselves, people is, I'll retire at 65. And why? That's when Medicare starts in. That's when the healthcare starts in, right? That's the most common answer. Now, I understand that here as well. But we have to ask ourselves, well, if I have money, if I plan ahead, if I'm proactive on there, if I could retire at 55 or 58 or 61 even, I don't want to just wait till 65 simply because of healthcare. So if I have to pay for healthcare, what are my options and how does that work? Now, of course, there's going to be what's called COBRA. If you are employed and you have a plan and you leave your employer, COBRA will typically be 12 to 18 months of coverage, but you are paying the full premium price for that on there. Now, there's the other popular one under the Affordable Care Act with healthcare.gov, for example, on there that you can look at to see what would healthcare costs be. Now, a planning idea here is that the Affordable Care Act, it's not based on your net worth. It's based on that taxable income you have coming in. So you could do a lot of planning here to help lower the cost of healthcare with the Affordable Care Act by using items like that Roth IRA, by using items like layer 1, that taxable brokerage account as well, and by using these to hopefully get a lower cost on healthcare with the Affordable Care Act.
Now, can you give a sense of what the cost difference actually looks like?
Yeah, so I mean, for example on here, right, a couple in their late 50s on there having a fully unsubsidized ACA premiums on a comprehensive plan. Now, again, they have bronze plans, silver plans, and gold plans, right? So even on a low end, it could be $2,000 to $3,000 a month in coverage or more, depending on a number of factors that are out there. That could be $24,000 a year. That could be even up to $40,000 a year, depending on a number of factors as well. And that can really add up, which is why you have to be intentional with your planning for these individuals and families, because healthcare can be one of the largest expenses, and you don't want that to be the only reason you can't retire earlier. So if we can plan ahead with the Roth IRAs, plan ahead with the layer 1 taxable brokerage account, and plan ahead with us on there, maybe we can even lower the cost of healthcare if possible as well. Now again, 2025, 2026, we all saw a huge change in the way that the Affordable Care Act has these subsidies, and they changed their formulas to make it more strict as well. So you also can't rely on it's always going to be this way. So I would say to you is, if it's going to be 30 grand a year, put that into your plan as your worst case scenario. I'm paying 30 grand a year. That way, you know, if that's what you have to pay, you have to pay. Because if you go in saying, well, it's 30 grand, but I'm going to plan on paying only 15, and then the laws change and now it's 30, that can derail the plan on there as well.
So what we encourage everyone to do always is at least 3 years or more to retirement is to visit healthcare.gov, look up your own pricing costs and quotes with the various plans. That way it's a free resource and a tool that will give you the clarity and awareness of potential costs, so you can now plan with the real numbers compared to the unknowns.
Yeah, we encourage people all the time on there, right? We say, go to healthcare.gov. It's free on there. There's no email, nothing you got to do. Put in yourself, put in your ages, put in your family, find out what the plans are. But that way you now have a number that gave you awareness and a number that gives you a baseline to go off of.
And the what happens after you die legacy section of the various accounts type is one that most people do skip because it feels distant. But there are real tax implications here that directly affect decisions that you make today while alive. Walk us through, David, how the 3 main account types are treated differently when passed on.
Yes, it's such a generally important and unfortunately so overlooked and misunderstood by so many people before it's too late, which I ask about often. But the account types, right? Whether it's the IRA, the Roth IRA, or the taxable brokerage account, like the big 3 types that are out there, right? When you pass away, that inheritance you leave to that spouse, to those loved ones, and how they are taxed is greatly different. And you have to plan ahead before you pass away to be aware of these and to make the changes on there. So for example, you have that IRA and it become an inherited IRA when you pass away. Now, in general, when you inherit an IRA, you typically have 10 years that you must withdraw that entire amount from that account. Now, there's other things like RMDs were occurring and how much are on there, but typically you get 10 years to take all that money out if you have inherited them. Now, that is still going to be taxable to the beneficiary. So say if my father passed away, I inherited that account as an IRA, I have to take out money every single year. It's now taxed at my income rate. And if I'm working, making $200,000 a year, and I have to take money out of the inherited IRA account, that is also taxed on top of my income as well. So the taxes can add up, and there's more that happens to your spouse that we'll discuss later too. The next one on here is the Roth IRA. You also get a inherited Roth IRA account. Now again, in general, you typically have 10 years as well to take the money out of this account, but there are no required minimum distributions like the last one had on. You have to get 10 years. Now, same thing on here. My father passed away. I inherit a Roth IRA. I get 10 years to take that money out on there. Assuming they are qualified withdrawals, there is no taxes I pay. So again, I'm making $200,000 a year. I got to take money out of the inherited Roth IRA. I don't pay any tax on that anyways. So it's a big difference too. Then the third one is that layer 1, that taxable brokerage account on there we talk so much about. Now this one is very different, which is why I kind of like this one so often, is that you receive what's called a step up in basis. So a step up in basis is what you can receive from some account type on here. Here's an example on there, right? Maybe you have $1 million of your cost basis over time in this account. You've had $700,000 in gains that have occurred in this account. Well, when my dad passes away and I inherit this account type, the step up in basis is based on fair market value at time of death. So it goes up to $1,700,000. I don't pay any tax on the $700,000 gain. I receive the full $1.7 million tax-free, and I'm not required to take the money out at any point in time either. So it's very different in that account type too.
So, and there is the surviving spouse situation that most couples do not plan for. I know you touched on that briefly.
Yeah. So, I mean, if you are married, especially, we've personally seen those clients we know personally, we know from other advisors here as well. But when you're married, you have the married filing jointly status, of course, that's on there. And that gives you a little better tax rates that occur. Same tax brackets, but the income levels are different. Your standard deduction is also different on there as well. But let's say, for example, on here, right, my wife has passed away on here now. I now go to a single tax bracket that does occur on there. So now I'm in a single tax bracket. If I had a lot of money in the IRA, or I had a lot of money in that 401k account, I'm going to be being paid more money in taxes now because the income brackets are different for that single person that occurs, which is why it's so important to maybe consider doing more Roth IRA conversions or having more Roth money when you're married, or having more money in that layer one taxable brokerage account for that stuff and basis as well when you're married, because when your spouse passes away, it's too late to make any changes.
So let's share an example. Two families, same wealth, same effort, very different outcomes. Let's walk through that.
Yeah, so as Ashley said on here, here's two families, same amount of money on here. Both families, they have saved $1,500,000. Both earn strong incomes. Both were disciplined in their saving, and they're accumulating over 20 years with the same effort. However, there's one major intention and difference that has occurred. One family knew of the 5 layers. One family knew of them, but didn't actually plan to utilize them on there, right? So we kind of have family A, like so many do, they put an over concentration into that 401k or that TSP or those IRAs that are all tax deferred accounts, very heavily invested. On paper, it looks great, but when they want to retire at age 56, as an example on there, there are structural restrictions. As we discussed earlier on here, the taxable brokerage also is too small to bridge that gap that we talked about, and the Roth balance is very limited as well. And eventually they will have the RMDs in the future. So now they have to be aware of that early withdrawal penalty, those tax penalties as well. As opposed to family B, they layered with intention throughout their time on here. So they have some money in that taxable brokerage account that we talked about with that long-term capital gains or cost basis, some money in that Roth IRA account that we can utilize, and they also have some money in that 401k or the IRA accounts on there as well. But now they have that stability on there, and they're structured where they can take out money at age 56. They can have lower taxes, avoid penalties, and avoid fees on there as well. And potentially, as we discussed about, their healthcare could be a little lower with the ACA premiums or subsidies because of the fact they have a different structure on there.
So same savings, same income, same effort, but one built with intention and one built by default. The difference is not effort, it is truly awareness.
Yeah, and financial planning, again, it's not just about numbers. Numbers absolutely matter, but it's not only about numbers. It's how those numbers support your life, your time, your relationships, and your own ability to have clarity and that awareness.
And when the structure is unclear, the mind continues to analyze. The nervous system stays unsettled. There's tension behind decisions that should feel simple. This is why these 5 layers discussed, plus the healthcare and the legacy inheritance, are crucial into not only early retirement potential, but to more successful retirement as well. And when that clarity is present, decisions begin to lift. And what once felt complex begins to feel simple, grounded, and aligned. Moving toward early retirement becomes not just an idea, but that something else does, but it becomes a structured possibility for your life.
And so, I mean, the question is not whether it is possible,
right?
The question is whether the structure you currently have, the structure you're creating your own self, allows you the potential possibility to retire earlier, which is why you get to review your own plan you currently have.
So if you want to go deeper on this framework, we have created a free Awaken Wealth and Life Alignment Guide on our website. The link is in the description below.
Yeah, and if you're ready to explore how these layers apply to your own specific situation, you can always schedule a free Wealth and Life Alignment call with us here via our website.
Yes.
Now, we are a flat fee, no asset under management fiduciary financial planning firm. We are registered here in North Carolina and Arizona, and we are more than happy to talk with you and go over conversations or to answer your questions, because we're here for education, that clarity and that awareness.
Yes, and if this video was useful, we would so appreciate a like, a subscribe, or even a comment to help others learn as well. We publish new educational videos and real case studies every week. The links to everything mentioned are in the description below.
And as always, this is educational only, not financial, tax, or legal advice. Always consult a professional about your own situation, your goals, and needs.